The Federal Reserve tells us its number one job is to fight inflation and keep prices stable. But what if that's not the whole story? What if the Fed's real priority in a crisis isn't your cost of living, but protecting Wall Street from a total meltdown? In this video, we'll uncover the historical moments where the Fed arguably chose to rescue markets and what their decisions might really mean for your money. For decades, we've been told a simple story. The Federal Reserve, America's central bank, has a clear mission from Congress, the famous dual mandate: keep employment high and prices stable. It's supposed to be a balancing act. When the economy is weak, they cut interest rates to get people borrowing and hiring. When things get too hot and prices rise, they hike rates to cool it all down. It sounds straightforward, right? A technical, apolitical process to keep the economy steady for all of us. But behind that official story, you could argue a different reality has emerged. You see it not by listening to what Fed officials say, but by watching what they do, especially when their backs are against the wall. Over the last 40 years, a clear pattern seems to have taken shape. You could argue that a third unspoken mandate has started to take precedence over everything else: financial stability, or, to put it more bluntly, preventing the stock market and the entire credit system from collapsing. It seems every time a real choice has to be made between fighting inflation and saving the markets, the decision has been remarkably consistent. Today, we're going to dissect that pattern. We'll look at the key moments in history that reveal what many believe are the Fed's true priorities. We'll explore how one event in the 1980s may have traumatized the institution so deeply that it changed its DNA forever. And most importantly, we'll connect these high-level decisions to your wallet, showing how this hidden focus may have fueled a massive transfer of wealth, punished savers, and created a system that can feel rigged in favor of those who own assets. This is the story of how the Fed's priorities may have shifted from fighting inflation to fighting for the survival of the markets. So, to understand where things might have gone off the rails, we first need to get a handle on the official rulebook. The Federal Reserve's public mission is built on its dual mandate, handed down from Congress in 1977 when the country was getting hammered by both high unemployment and runaway inflation. The two goals: maximum employment and stable prices. Let's break that down. Maximum employment doesn't mean literally zero unemployment. There's always some frictional unemployment as people switch jobs. Instead, it means the highest level of employment the economy can handle without sparking too much inflation. It's about a healthy job market where people who want work can find it. The second part is price stability. For years, this was a pretty vague concept, but in 2012, the Fed made it official: a 2% inflation target. Why 2%? The thinking is that it's a Goldilocks number, low enough that you don't have to worry about your savings losing value overnight, but high enough to avoid deflation, which is a dangerous spiral of falling prices that can paralyze an economy. The Fed's main weapon for hitting these targets is the federal funds rate, the interest rate banks charge each other for overnight loans. By moving this one rate up or down, the Fed influences borrowing costs for everyone, from mortgages to business loans. A huge part of their strategy revolves around a psychological trick: anchoring inflation expectations. The theory goes that if we all believe inflation will stay near 2%, we'll act that way. Workers won't demand huge raises, and businesses won't jack up prices ahead of time. It becomes a self-fulfilling prophecy. This credibility is supposed to be the Fed's superpower. It's a neat and tidy story. The Fed is a team of impartial economic mechanics, carefully steering the giant ship of the US economy. But this textbook narrative starts to fray when you look at how the Fed has actually behaved under pressure. The official story is what the Fed says in peacetime. Its true character, one could argue, is revealed in times of financial war. And to understand that change, we have to go back to the one man who truly waged war on inflation, and in doing so, scarred the Fed forever. To understand why the modern Fed seems so hesitant to truly crush inflation, you have to understand Paul Volcker. In 1979, when he was appointed Fed chairman, the US was in chaos. Inflation was out of control, hitting over 13% a year. The dollar was collapsing, and it felt like the whole economy was coming apart at the seams. Volcker was an imposing guy, standing 6'7", often with a cigar, and he had an equally imposing belief: that inflation was a disease that had to be cured, no matter the cost. He believed the Fed had lost all its credibility with the wishy-washy policies of the past. So, Volcker declared war. He jacked up the federal funds rate to levels that are unthinkable today, eventually hitting a peak of 20% in 1981. The effect was brutal. Borrowing money became impossible. Businesses couldn't expand, the housing market froze, angry car dealers mailed car keys to the Fed in protest, while home builders sent bricks to symbolize an industry that had ground to a halt. The American economy was thrown into two back-to-back nasty recessions. Unemployment shot up to 10.8%, a level not seen since the Great Depression. Volcker became one of the most hated men in America, but he didn't blink. He was convinced that this short-term pain was the only way to break inflation's back for good. And he was right. By 1983, inflation had plunged to under 4%. The Volcker shock, as it came to be known, had worked. He slayed the dragon and is now remembered as a hero of central banking. But that's not the lesson the Federal Reserve itself seems to have learned. For the institution, the real takeaway wasn't the victory, but the trauma. The Volcker years showed just how much economic pain and political hell had to be endured to truly put price stability first. It meant killing jobs, bankrupting companies, and becoming a political punching bag. The Volcker shock wasn't remembered as a playbook, it was remembered as a near-death experience. The lesson his successors seemed to internalize was not, this is how you fight inflation, but let's never, ever do that again. This institutional trauma set the stage for a huge shift. The fear of repeating Volcker's recession created a new, more immediate fear, the fear of a collapsing market. And the man who would write the first chapter of this new playbook was Volcker's own successor, Alan Greenspan. When Alan Greenspan took over as Fed chairman in August 1987, he was a very different kind of leader. Where Volcker was a sledgehammer, Greenspan was a master of Fed speak, a deliberately fuzzy language meant to soothe markets. He wouldn't have to wait long for his first test. Just 2 months into his job, on October 19th, 1987, Black Monday, the stock market had its worst day in history. The Dow cratered by nearly 23%. Panic was in the air. All eyes were on the new Fed chairman. He did not channel Paul Volcker. Instead of worrying about inflation, Greenspan's Fed acted fast with one goal: restore order. The morning after the crash, the Fed issued a simple one-sentence statement: "We are here and ready to provide liquidity." Behind the scenes, they did much more. They pumped money into banks, told them to keep lending to stockbrokers, and slashed interest rates. It worked. The panic stopped. But in the process, Greenspan set a new precedent. He signaled to Wall Street that if things got ugly, the Fed would step in to break the market's fall. This was the birth of the Greenspan Put. A put option protects you from losses. The Greenspan Put was the market's belief that the Fed was providing a free insurance policy against a total market collapse. Investors felt they could take bigger risks because if things blew up, the Fed would ride to the rescue with cheap money. This pattern repeated itself. When the hedge fund long-term capital management blew up in 1998, the Fed helped arrange a bailout and cut rates. After the dot-com bubble burst in 2000, the Fed aggressively slashed rates from 6.5% all the way down to 1% to cushion the fall. Each time, the justification was to protect the wider economy, but the immediate effect was to rescue financial markets. This created a dangerous moral hazard. Investors were rewarded for taking huge risks, knowing they'd be bailed out of the consequences. They learned that "don't fight the Fed" wasn't just a slogan, it was a profitable strategy. This was a radical shift. Volcker was willing to crash the economy to save the dollar. Greenspan, it seemed, was willing to risk long-term problems to save the stock market. The Fed's unspoken mandate was taking shape. It was becoming Wall Street's chief firefighter, always ready with a hose full of cash. This new role would be tested like never before in 2008. The financial crisis of 2008 was the ultimate test of the Greenspan Put. Years of low interest rates and the unspoken promise of a Fed rescue had fueled a massive housing bubble. When it burst, the entire global financial system stared into the abyss. With the collapse of Lehman Brothers in September 2008, the credit markets, the lifeblood of the economy, froze solid. The world was facing a potential repeat of the Great Depression. The Fed, now led by Ben Bernanke, a scholar of that very era, had to act. And the response was like nothing anyone had ever seen. The Fed didn't just cut interest rates, it slammed them all the way to zero. And when that wasn't enough, it unleashed a weapon that had mostly been theoretical: quantitative easing, or QE. QE is a fancy name for a radical idea: creating money out of thin air to buy financial assets. The Fed started buying hundreds of billions, then trillions of dollars worth of government bonds, and, crucially, the toxic mortgage-backed securities from the banks. Let's be clear about what this did. The official goal was to help the broader economy, and it did help prevent a total meltdown. But the most immediate effect was to bail out the financial system. By buying their bad assets, the Fed took the junk off the bank's balance sheets and replaced it with fresh cash. The Greenspan Put was a promise to cut rates. The
The Bernanke put was a promise to turn on the electronic printing presses and flood the system with trillions. A new line had been crossed. The Fed wasn't just a lender of last resort, it was now a buyer of last resort for the entire market.
From 2008 to 2014, the Fed's balance sheet swelled from under $1 trillion to over $4.5 trillion. While Main Street endured a slow, painful recovery, Wall Street, fueled by this river of new money, roared back to life. The stock market took off on a historic bull run that seemed completely detached from the real economy. You could argue that the 2008 crisis is what solidified the Fed's hidden mandate. The institution proved it would shatter every norm to save the financial system. The idea that the Fed would ever again stand by and allow a major market crash, let alone a Volcker-style recession to fight inflation, now seemed laughable. The market was no longer just part of the economy. It was now the patient the Fed was sworn to keep alive at any cost. If 2008 was when the Fed's hidden mandate became clear, the COVID-19 pandemic in 2020 was when it became absolute. As the world locked down in March 2020, financial markets went into a free fall so fast and violent it made 2008 look slow. The Fed, now led by Jerome Powell, didn't even hesitate. The 2008 crisis had created the playbook, and Powell executed it with breathtaking speed. In a matter of days, rates were back to zero. But that was just the warm-up. They then announced a supercharged version of QE. This time, it wasn't a fixed amount. The Fed committed to buying assets in the amounts needed, what many called unlimited QE, to stabilize markets. But they didn't stop there. They shattered another taboo by announcing new programs to buy corporate bonds. For the first time, this included exchange-traded funds that held some high-yield junk bonds, effectively bailing out major corporations. In just a few weeks, the Fed's balance sheet exploded by another $3 trillion. The response that took years in 2008 was deployed in a matter of days. In those frantic first weeks, the dual mandate seemed to take a backseat. The singular goal was to put an immediate floor under collapsing financial markets. And once again, it worked. The market bottomed in late March and began a speculative frenzy. But this time, there was a devastating side effect. The combination of the Fed's monetary fire hose and massive government stimulus ignited the worst inflation in 40 years. This created the Great Whiplash. For over a year, as prices for gas, food, and housing soared, the Fed insisted the inflation was just transitory. Why? Arguably, because the alternative was to admit it was a real problem and start raising interest rates, the very thing that would threaten the everything bubble they had just spent trillions to create. They were trapped. Acknowledging inflation meant threatening the markets, and the unspoken rule is that the markets must be protected. It wasn't until inflation hit peaks of over 9% in 2022 that the Fed was finally forced to act, starting one of the fastest rate hiking cycles in its history. But even then, every time the market wobbled under the pressure, talk of a Fed pivot back to lower rates would immediately start up again. The COVID crisis laid the Fed's priorities bare, according to this view. First, save the market at all costs. Second, deal with the inflationary fallout later, and only when it becomes politically impossible to ignore. The argument is that this hidden mandate is no longer hidden. It has become the Fed's primary operating principle in a crisis, even as official statements continue to reaffirm the dual mandate. So, what does this all mean for you? Why should you care if the Fed is more worried about Wall Street's portfolio than the price of your groceries? Because this shift in priorities has direct and often painful consequences for the average person. First, the existence of the Fed put creates what economists call moral hazard. When big players believe they'll be bailed out of their riskiest bets, they have no incentive to be careful. They pile into speculative assets, driving prices to insane levels, confident that if it all goes wrong, the Fed will turn on the money printer and save them. This privatizes the gains for Wall Street and socializes the losses onto the public, either through bailouts or the hidden tax of inflation. Second, the Fed's main tool for rescuing markets, quantitative easing, is seen by many economists as a powerful driver of wealth inequality. When the Fed creates trillions of dollars, it doesn't send that money to you. It injects it into the financial system, and that cash flows into assets. Stock prices soar. Real estate prices skyrocket. Who owns these assets? Overwhelmingly, it's the wealthiest 10% of Americans who own nearly 90% of all stocks. The Fed's actions, while intended to support the whole economy, have acted as a massive subsidy for the rich, inflating the wealth of those who already have it. Meanwhile, what happens to everyone else? You're left with the consequences. The biggest one is inflation. While asset values explode, the cash in your savings account is systematically destroyed. Your cost of living goes up, but your wages might not. That house you were saving for, its price just got pushed even further out of reach by the very policies designed to stimulate the economy. This creates what many call a K-shaped recovery. Asset owners ride a wave of Fed-fueled prosperity, while wage earners are crushed by a rising cost of living. The Fed's cure for market instability, some argue, is the very disease that creates financial trouble for millions of households. They aren't solving a problem, they are shifting the pain of a market crash away from investors and onto the general public. From this perspective, the dual mandate starts to look less like a rigid rulebook and more like a convenient story. The Fed, of course, maintains that its legal framework remains the dual mandate of employment and inflation. But the uncomfortable argument is that the system is no longer working according to the textbook. The real mandate in practice seems to be ensuring the financial system doesn't collapse. If this helped you understand what's going on behind the scenes, make sure you subscribe. But even more importantly, join my free newsletter below. Every week, I break down the financial stories the mainstream media won't touch. And I'm getting ready to launch my first ever personal finance and economic survival class. The very first people who get access, including early bird bonuses, will only be my newsletter subscribers. So if you want to actually prepare and not just react, join the newsletter. Links below. Let's pull it all together. We started with the Federal Reserve's official story, an institution with a dual mandate for stable prices and maximum employment. But as we've seen, that official story starts to look a bit shaky when you examine the last 40 years. The real history of the modern Fed, it can be argued, is a story of fear. It began with the trauma of the Volcker shock, which taught the institution that the political price of truly fighting inflation was just too high to pay again. That fear gave birth to a new, unspoken priority, which began with the Greenspan Put in 1987, a promise to protect markets from collapse. That promise arguably grew into an unbreakable doctrine. In 2008, the Fed unleashed QE, printing trillions to rescue the banks. In 2020, they went to unlimited asset purchases, buying everything from government bonds to corporate debt to put a floor under the market. Time and again, when faced with a choice between fighting for the value of your dollar and propping up asset prices, the Fed appears to have chosen the latter. This isn't a conspiracy theory. It's a pattern of behavior written in trillions of dollars on their own balance sheet. This isn't just an academic debate. It's one explanation for why your savings buy less each year, why home ownership feels more distant, and why wealth inequality has reached extremes. The Fed's actions have arguably created a world where saving cash is a losing game. So, how do we navigate this reality? It starts by understanding that there are two competing ideas. The Fed's official stated mission is to keep prices stable. In its 2025 framework review, it reaffirmed its 2% inflation goal and dropped the average inflation idea it tried in 2020. But you also have to weigh the evidence from the last 40 years, which suggests that in a real crisis, their first instinct will be to flood the system with liquidity once again. The Federal Reserve isn't just America's central bank anymore. It has become the de facto backstop for global financial markets. And until that changes, their fight may not be for the value of the dollar in your pocket, but for the value of the portfolios on Wall Street. If this opened your eyes, make sure you hit subscribe and join my free finance newsletter below. I give you weekly breakdowns you won't hear from the mainstream. Plus, I'm launching my first finance class soon, and newsletter subscribers will be the first to get access.